This week, we are digging into grocery-anchored shopping centers. Our guest this week is Nick Hodge. He has a family history of almost 100 years in the supermarket industry with the Kroger company, but he has since broken out on his own. Nick is now the CEO of Essential Growth Properties. Essential Growth buys and builds and operates grocery-anchored shopping centers with anchors like Publix and Kroger. Recently, Naveen, Jaggi, and I had a chance to sit down with Nick while we were all in New York at the ICSC conference, and we found out where the investment opportunities are right now for grocery-anchored centers. We're looking beyond the primary markets, what Nick's strategy is with the company overall, and what his goals are for the future of Essential Growth Properties. Live from New York, it's Where We Buy. That's right, you're listening to Where We Buy. It's the show where we talk with retail experts and we visit the places where we buy. My name is James Cook. I research retail and real estate for JLL. And today we are recording live from the JLL booth at ICSC New York. My co-host for today's episode is Mr. Naveen Jaggi. Welcome, Naveen.
Always great to be here, James.
Naveen, introduce yourself for those who don't know you.
I am the president of Retail Advisory Services for North America for JLL.
That means you do a little bit of everything, I guess.
That means I do a little bit of everything.
Yeah.
That's right.
Everything retail real estate, that is.
Which is what I love.
Yeah. Our guest today is Nick Hodge, CEO and principal at Essential Growth Properties. Welcome, Nick.
Thank you, James. Great to be here.
Okay, so Nick, everybody knows what a CEO does, right? What is? So I don't have to ask, how do you describe Essential Growth Properties?
So Essential Growth Properties is a private equity fund that's solely focused on acquiring grocery-anchored shopping centers across the country. To date, we have acquired 22 centers, about 3 million square feet, mostly Kroger-anchored centers, 18 Kroger centers, a couple of Publixes, a Tony's, and a Cub Foods. But we're owners and operators and value creators and investing private capital through a couple of funds to get to where we are today.
You've got a unique background, right? Tell us about that.
I do. So I was the head of real estate at Kroger for 6 years, was with the company for 20 in various capacities, site selection, new store development, ultimately ran a $3.5 billion annual capital expenditure program. With that was new stores, remodels, fuel centers, et cetera. Prior to that, my father was head of real estate there for about 30 years. And my grandfather, I didn't do the math until I left the building and I was shamed over it, but my grandfather brought another 30 some odd years. And so we left it 92 years of total coverage between the three generations. And so almost got to 100.
Wow. Now that's saying something.
But I will tell you this too. It's a very loyal business.
Yeah.
I was 18 or 19 years old in college. My father was still getting my return checks in the mail. And I wrote like a $2.47 late fee check to Harris Teeter, who Kroger didn't own at the time, right? And it shows up in his mail, and he sends it back to me with a note that says, if you want me to continue to keep helping you with college, you will keep these to an absolute minimum.
And back then it was $2.30, right?
Exactly.
So after you get out of college, do you go right to Kroger after that?
I left as an English major. And you too?
English literature, right here, baby.
You know what, all kidding aside, I've been able to write my way to get what I want for the last 30 years. And so, no, it was a good major, but I wanted to get into real estate. My whole family was in it. And I took a job with Prologis out in Denver. And I spent 4 years on the REIT side of it, saw acquisitions, due diligence, learned how to underwrite real estate, learned how to do marketing and leasing. And I'll tell you, I loved every aspect of it, got a lot of deal flow and a lot of experience. But showing up when I jumped over to Kroger 4 years later, showing up at that first store opening, you see 300 people outside, you see the band, all the community, it fires you up. And those are 4 or 5 year projects in some circumstances to get those stores open. So I got the grocery bug
pretty early on.
The moment, I think that was like my first month on the job, I went to my boss's opening. So I loved it at Kroger and loved every minute of it.
You were hooked right then.
Yeah.
So, Nick, I can't help but think about life coming full circle. You and I did this about 15, 16 years ago.
We did. Back in our past lives. My kids still look at that on the internet to see when I had non-gray hair.
That's right, yeah.
Tell me about this. What did you do?
So this goes back about 2009, I believe, or 2010. And I was a CB at the time, and I was running retail tenant rep for CB. And we decided to do a couple of these televised, videoed interviews with key clients that we like to work with, that we quote liked as family members, if you will. And Nick's brother, Chris, senior retail broker at CBRE, said, "You need to talk to my brother. I mean, he's the guy that's at the Kroger." And I said, "Let's do it." So Nick and I got on an interview, probably a 2 or 3 minute interview on video. And to Nick's point, what I didn't know at the time was that they put it on the internet like right away. And to Nick's point again, I've had my kids do the same thing. And when they were like, "What does dad do?" Like when my kids were in elementary school and they had to report on what does dad do? And one of my kids actually went and found the video and they came back and said, "Dad, we didn't know you did that. That's cool."
I think it's got 47 views, and I think 40 of them are our kids.
And the other 7 are accidental views, right?
Exactly.
So this brings up a question. 15 years ago,
About
what is the biggest change in your world in those 15 years? And I mean the industry.
Yeah.
What's the biggest change that you've seen?
I think, gosh, there's a lot of them, but I think for me right now, it was 15 years ago, there was an abundance of opportunities to grow. You had developers with capital, you had availability of land, you had growth, and you could underwrite that next development deal. And today, I think, and a lot of this is my learnings with the new hat on, but the limited supply, the ever-increasing demand by tenants, and the lack of available spaces for people to go is so different than it was 15 years ago. And we can get into the whole, the other answer is technology.
Right.
But for me, the overall development industry is so different.
Yeah, I think the bread and butter of our business is still finding locations to do real estate transactions for a community and for a retailer demand, right? Retailers demanded. And in your case, all those years working with Kroger, it wasn't just Kroger, it was another 100,000 square feet of ancillary retail space around it, right? They had 3 pads with a bank and a couple of McDonald's type things. And then you had the shadow maker space. We're not seeing that being developed right now. And so there's a real noticeable lack of quality real estate, right, Nick? So maybe my question to you is, as an investor, now you're looking out there and saying to yourself, "I'm going to go find some product for our portfolio," right?
Mm-hmm.
We've heard for the better part of 2 years now that the grocery anchor shopping center is the most in-demand asset class in the retail sector. In such a heated demand area, what are you doing that says, because of my background and my knowledge in the grocery sector, how are you looking at those opportunities to say, here's where we go pursue opportunities?
I mean, it's a great question. I mean, I think first and foremost, I've been spending a lot of time looking in very strong Midwestern secondary, very strong tertiary markets where I think I know something that maybe the market doesn't. Okay. And that information gets to be a lot more symmetrical when you start to look at core markets and things like that. But when you start to find yield and value, and you can see 8 caps in some markets where you might know that the anchor wants to expand, or they have these 3 needs that you can really help them out with.
Right.
Those have been the kinds of locations that I've been looking for. To me, it was, how do you find the ability to work with that anchor tenant to extend, to
Right.
remodel the store, to provide them with the capital that they need, that they deserve if they were to extend the lease in order to do that? Is the center, you've got a 90% lease center, but can you go down the line with that tenant mix and share with them that your anchor tenant is committed?
Right,
And
right.
how do you use that to get more excitement downstream in the center to raise rents and to get them further commitment from the franchisees or the tenants? And so those have been the kinds of things that we've been looking for. Obviously, when you look at, parking fields, tenants' needs have changed over the last 15 years. And so, and they all want to be more flexible, but also participate in the creation of pads and so how do we play a role in that? And so I don't know that we've got a true magic thing with it, but I do think that knowing what's important to the anchor tenant has been helpful to us.
The thing you have, your big advantage is you were a former real estate guy at a grocer.
Correct.
You're buying grocery anchor centers, all the machinations that go on to make it successful. Now you're focusing on the Midwest by your comment, mostly Kroger anchored centers. Obviously Publix is part of it. Is Essential Growth looking across the country, or are you kind of focusing on those 3 or 4 areas that you guys have had success in?
No, we're looking across the country. I think for us, I'm proud of the fact that we've stood up 2 private funds. They are retail oriented, friends and family, high net worth. As we've evolved, we've brought in more fund to funds type investors that have brought us some more scalable capital.
Nice.
And that's where we are today.
Right.
With them, though, I can tell you that we've been very focused on yield.
Yeah, have to.
We've been very focused on being able to deliver our preferred return. The first moment that you have to sit there and talk with your investors about that being a blip is it's a blemish on your track record, right? And so what I'm evolving to, and what I think our skill set is evolving to now that we've moved from grocery retail experts to, I'm becoming a better operator. I'm becoming a better merchant of these centers as I'm learning more and more as we go along, a better investor in real estate.
Right.
And I think that as you've built up that track record, you can start to look at long-term value creation opportunities that might not be as cash flow accretive in the early years, but you can actually execute. And again, I'm proud of the team we've built. I mean, you look at some of the executives that we've brought in to build leasing, to build acquisitions, to build property management. We've been very disciplined and diligent about bringing in really great talent to lead these. And it's stuff that to bring in people that have done this on the operating side that can cover my blind spots.
That's what you need. Good partners.
That's what I did. And so I think with that, that allows us and puts us in a position to play a little bit differently in 25 and to look at different assets. And so does that mean I want to be Sunbelt focused? I still want to find value, and everybody's going to be down there looking, but I don't want to limit ourselves to where we look. We've just been hunting where we've been able to find that yield. Yeah.
And I've heard that a lot. I've talked to so many REITs, and they've said they're taking their focus off of the Nashvilles and Austins of the world. Those are overheated. And they're looking at Chattanooga as an example, Lexington, good markets that just haven't been overpicked and overheated. And so maybe as a segue to that question, as you think about places that you want to focus on, not to give away a secret, but more talking about how you think about the markets, it's really not going to Cincinnati or Columbus, these mature markets. For you, you see at Essential, let's focus on what we know. What we know is a suburban market, not urban market, right? Yeah. And are you seeing the results from those? You said you got 22 assets around?
We do. So, I mean, I'm comparing small sample size. 2/3 of my portfolio is in the Midwest.
Yep.
We've got some Sunbelt. What I would tell you is that from a leasing perspective, we're seeing the same velocity of deals.
Nice.
We're seeing the same supply and demand dynamics, the same opportunity to move rents along in the Midwest as we are in the Sunbelt. I haven't seen any material differences with those. So I am happy in that. And the other thing I would tell you would be we've bought a number and we've sold a couple in the Midwest.
Okay.
And there's a liquid buyer pool. When we're bidding or when we're selling, there's 10 to 15 legitimate competitors that are going after the same real estate. And so I think people like myself need to prove, how do you aggregate this? How do you roll it up? How do you tell the Midwest story in total? But on a one-by-one basis, it's proven to be a very strong investment.
I love the fact that you're talking about the Midwest, because in all the years that I've been in the business, and especially for the last few years, and we're talking about post-COVID, there's been so much focus on the Sun Belt, the Southeast, and the Southwest, Texas, Alabama, Texas, Georgia, Florida, Arizona, Phoenix, LA. That's kind of that curve we talk about so much. And I think hidden in the conversation is the fact that the Midwest is still a very healthy market. It just doesn't get talked about as much.
Correct.
So I think for someone like you, who can be advocating for the fact that there's real quality value, real strong consumer demand, I think it's important, Nick, because I don't think enough people talk about the Midwest. So maybe I'll let James jump on that, but I think the Midwest needs a little more advocacy.
I mean, that's where I live. So I'm a fan. I'm based out of Indianapolis.
Yes.
Well, the thing with the Midwest, too, is that it's got a strong consumer pool, but we don't have the growth numbers like your Floridas and your Phoenixes. We're there, but we're not like showing explosive growth. And I think a lot of times investors, that's what they want is the growth. So that's what I think why we often get overlooked. But yeah, I'm a huge fan, and we all spend lots of money on groceries and other things in the Midwest too. Nick, something else I want to ask you about. We talked, say, that time window of 15 years. In that time, a big thing, and then it really pumped up during COVID, was shopping online for groceries. Has that impacted how you look at a center and how you perceive its value, or is that not as big of a deal, the online grocery stuff?
I mean, I think it doesn't affect how I perceive a center. I mean, certainly when I'm looking at it, I'm going to look at the space constraints to make sure that the tenants that are building up their online presence have what they need in order to drive their business from a physical location. Is there a pickup location? Do they have the right number of stalls? I think the landlord industry, and I was at Kroger at the time, could not have been more adaptive to helping the retailers figure that out 6-7 years ago. So I think that's played out to where physically it can. I think from my perspective, if you look at 15-16% of sales at the grocery level going online during the pandemic and then really staying at that level, but yet brick and mortar foot traffic continues to grow. I think that it's been proven out over and over again that there's a halo effect from buying online, picking up in store. Now you have the ability to return in store, and that drives additional impulse purchases. And so I'm a big believer in the fact that, and I believe this at Kroger, which was you've got a customer who one day is going to want to shop online. Next day they want delivered. Next day they want to go in store. And the moment you take one of those stools away, leg of the stools away, it goes away, right?
Yeah.
And so it's lifting the entire boat. I think the best metric you can look at, though, would be, is your foot traffic increasing? And we look at it just like everybody else and use the same data. And I think on an annual basis, you continue to see more and more growth of people at your centers. Now that's incumbent upon us to make sure that we activate it, keep it exciting, keep the center fresh and a safe place for customers to come and shop. But I think I think the tenants need a brick and mortar place to complement the entire ecosystem.
100%. So I'd love to ask as a follow-up, all we've heard for the last 3-4 years or more, placemaking, right? You're an owner, you're an investor, right? You buy a shopping center. How much of that do you take into consideration when you look at the opportunities that we've got to not just have a box with stuff in the box to sell, but we need to have some level of placemaking, excitement, some experiential curb appeal, whatever you want to call it, Nick. But kind of walk me through how you think about that aspect, which we hear about, but tell me in real life how you think about it.
Well, I think first and foremost, for the types of centers, the neighborhood centers that Essential Growth is acquiring, I think you've got your standards. And you notice this when you're on the property during due diligence. It's landscaping, cleanliness. It is the parking lot condition, talking to the tenants and understanding what you're not seeing as a consumer, but the roofs and the capital needs to come in here. But you need to make it inviting. You need to make sure that it's safe and clean. And those are table stakes right now for the customers. I would tell you that we have not gotten ourselves into the types of centers that require dramatic activation.
Right.
I can see where the lifestyle centers, the open air centers, I can see where that plays.
And the tenants may be expected as well, but you don't need a Ferris wheel in the parking lot of a Kroger shopping center.
No, you don't. But the other thing too is what I love about working with Kroger, both while I was there, but also going forward in this new capacity, is you don't have to talk to the Kroger about remodeling their stores.
Right.
They are refreshing, and it's no longer in 8 years and build it up to a $4 million remodel. It is every year they're looking at something that is connecting to the customer, and they're making that $500,000 investment, but they're changing decor to match so I think that if you go around the landscape now, you see the new signage, the new decor packages, and all of these things are more attractive to the customers that are coming in. And again, as an owner, when your tenants see that your anchor is making that kind of an investment, they don't know how much it was.
Right.
They know that your anchor is getting relevant and staying relevant, and they continue to do the same thing.
Right.
So for us, that's been the key. But I haven't thought about dramatic activation.
So Nick, can you talk about, do you have a certain goal of like number of centers you want to acquire or a timeline around that? Is that anything you can speak to?
It is. I can tell you that, I get asked the question a lot. And by the way, you called me CEO earlier. I was vacuuming the floors a couple of days ago. And we're still a young company, and it's a really nice title I was able to give myself. But
your chief CVO, chief vacuuming officer.
Exactly. In all seriousness, the best way I can describe it is, I don't want to do this 1 or 2 times a year. I don't want to find enormous arbitrage yields and do it once or twice and bring in syndicated capital. I would really like to build a team.
Right.
And I've already started building out a great framework of a team. I would like to have a vehicle that can someday go public and have that, whatever that right large number of properties is to do that. I'd like to have the support behind us to go out and play in larger acquisitions. So our average acquisition to date has been 15 to 20 million. That's been the right number to provide a diverse pool of assets for my current investor base. But as I think about what we've built up, the skill sets we have, it can truly play in the $50 million plus or minus arena as we continue to evolve and grow. And so I can see us evolving to larger acquisitions and still utilizing our grocery expertise and skill set to have an advantage there. And so that's some of our next step evolutions as a company. And I'd like to get it. I'd like to be doing this a very long time and build up something pretty large and special.
But always grocery anchored centers, though. You don't see yourself straying from that.
Yeah. I'm not trying to be cagey. I don't want to say never say never.
Yeah.
I think that the moment you build up a platform and you build up great expertises and you can start to figure out the right time to pivot and look for opportunities, sure, we'll build that platform up. But right now, investors trust me to be that expert in grocery.
Yeah.
And I'm still building up my strengths as an investor, my strengths as an operator. And with that, being in the grocery space is certainly a catalyst for success for me right now.
We'll do a little case study here. What was your most recent acquisition?
That's a great question. And it is a case study. My most recent acquisition was a Publix in Florida.
Okay.
And we got to closing on October 11th. This is in Tampa. October 9th, you start to get word of Hurricane Milton
That's
coming
right.
on board.
Yeah.
If you remember, that wasn't one of those brewing ones that just came at
That's
you.
right. That's right.
And on the 10th, it was coming right at the asset.
Tampa. Oh, God.
Yeah.
Yeah.
And I will just tell you that would have been a big problem for us if we bought it at 5 o'clock and
Hurricane hits it at 9.
Milton hits at 8. and here we are, and the
Right.
insurance are already aware. So we worked out a good situation where everybody had skin in the game for what happened, but it gave us some line of sight to figure out what that looked like.
Right.
And so that was my most recent acquisition. Got the blood pressure up. You wouldn't believe it.
Welcome to Florida.
Welcome to Florida.
Yeah.
I got a lot of those questions from my investors afterwards, and,
Right.
and I thought they were fair. And
Hurricane Alley is like Florida these
Hurricane
days.
Alley. And so thankfully the property nobody got hurt. The property
Right.
was fine.
Yep.
And now we're in execution mode. Yeah.
So maybe tell me a little bit about your experience working in Florida on an acquisition versus your history of working on acquiring projects in the Midwest. Was it the same, any different in terms of the way you approached it and different in terms of the dialogue and the way you conversed about that asset?
That's a really good question, Naveen, because I have, in my first 3 or 4 acquisitions, I certainly went out and saw the asset with an investor's lens on it, but I relied a lot on my knowledge of Kroger. What I will tell you is on the 2 assets, we bought one in Gainesville and one in Port Richey, and I spent a couple of days down there. Our head of acquisitions, who does this on every acquisition now, spent the same amount of time, but it really required us to immerse ourselves not only in the dynamics of the trade area, to go door to door, talking to the tenants. The leasing environment is just different down there. And so we've interviewed, 4 or 5 leasing agents to make sure that we pick the right leasing agent on that particular property. And so I just think that from my perspective, grocery centers operate similarly. Costs are different.
Yep.
Insurance costs are different in Florida. But from that perspective, I just think that we had to spend a lot more time in due diligence to make sure we understood what the consumer wanted down there.
Right.
And what was the right way to merchandise a center in Florida that might be different than how you merchandise a center in Indianapolis.
When you were down there, did you find yourself saying, hey, this is a place I want to spend more time in? Tell me and not from a pro and con, just in terms of understanding the environment for investments in Florida. Was it a place that you thought, this is a place I want to spend more time in from an investment standpoint?
I think it was. I mean, I think the people that I've talked to said, if you're going to be here, you need to expect that you're going to have this heart palpitation every 10 years over a hurricane, but you start to see it in faster growth with tenants. You start to see it in higher rent growth. The center that we acquired had some value add components to it, but they've got a 75,000 acre medical facility getting built, medical community, not even facility being built within a couple of miles of the property. And so I think those are the kind of dynamic changes you see in markets like Florida that drive economies versus what you might see in some of the Midwestern markets. And so with that, it might be a 5 to 10 year run, but that investment will get other great positive changes and other tenants. And I think that many communities in Florida are going to be on the upswing because of that. So it's not a paradigm shift for us.
Right.
We found value there. We like the opportunity. We're learning our way through Florida. There were some learnings we had in buying it that we would do differently.
Well, I mean, you just have me thinking, talking about this hurricane. I mean, it's not just a Florida thing. We're seeing more kinds of disasters in more places more frequently now. And as an investor, I guess there's only so much you can do to protect yourself. I mean, you do your due diligence as best you can, but nobody can control the weather or the wildfires or the earthquakes and the tornadoes and all that stuff.
Correct.
Yeah.
No, I mean, I don't know. I mean, I would tell you that, and being at Kroger, being at Prologis, I mean, there's always the unknowns. In the amount of heroic things that you see at a company like Kroger when you have floods in Houston, I don't even know where to start, but when you start to see Katrina and the after effects of that, I mean, people rally around it. You can't plan for it. I think having good insurance providers, ours worked with us great on this particular acquisition that we had. I mean, it de-risked our exposure there. And
it's a fact of life, right?
Fact of life.
It's a fact of life. Yeah.
Nick, Naveen, thank you so much for co-hosting. Nick, thank you for joining me.
Thanks for having me.
It's been a great conversation.
It's been a lot of fun.
All right.
Thanks, James.
That's a wrap.
If you like this podcast, do me a favor, go into the app that you're listening to and give us a rating. Or even better, give us a little review, right? Just a sentence about what you like about the show. You can subscribe to Where We Buy on the iPhone podcast app, on Spotify, or wherever you get your podcasts. Or you can always find us on the web at wherewebuy.show. We also post a ton of cool videos and interviews on LinkedIn and YouTube, video tours, interviews with folks that you won't hear on this audio podcast. You can check it out by going to the website everythingweknow.show. If you have a specific question about retail, shopping centers, or retail real estate, you can feel free to connect with me and send me a message on LinkedIn. You can find me by searching for James Cook, JLL. Our theme music is Run in the Night by the Good Lauds under Creative Commons license.